A lot of people are feeling like they've been taken for a ride. They feel embarrassed. They feel like they're getting outperformed by their grandmothers, disillusioned at the moment. Just because the hot ball of money is on one particular asset right now doesn't mean it'll stay there. The capital rotates. So as people get these nominal returns in one asset, they will take profits and then rotate that into other places that haven't had these asymptotic blow-offs yet. This tension between the fear of missing out on the hot ball of money and all the profits that are getting made on paper versus trying to evaluate assets for their real value while the market is ignoring you, because there's so many people right now, I think, trading on emotion. This is the gulf that I see. The fundamentals have never been stronger. The adoption has never been stronger. Bullish sentiment has never been stronger on the institutional side of the market. The sentiment has never been lower. That, to me, is the time to be accumulating. The point is the apex asset is at a point where it's got a cleaner thesis and a stronger thesis than it has ever had before, and nobody wants to buy it because they're all chasing data centers on Mars.
All right. Today, I'm very grateful to be joined by John Gillen. Sir, John, how are you today?
I'm doing really well. It's great to be here. And yeah, you're right. There's a lot going on in the market. So I'm looking forward to the conversation.
Yeah, absolutely. So you have an amazing background. You worked in BlackRock for a number of years, and now you are the host of Milk Road Macro. You talk to some of the brightest luminaries in all of macro on a weekly basis. So tell people a little bit about yourself and your experience in the markets.
Yeah. So as you said, I was at BlackRock for 6 years and I worked on the Aladdin platform while I was there. So I was primarily focused on client services and relationship management. And I got to work with a lot of the portfolio managers and traders who lead this entire industry. And I got to work with them pretty closely and understand their workflows and the software tools they were using to do that. At the time, I was also still helping out with some initiatives that we were working on internally at the firm around digital assets. Because as many people know, BlackRock has been a leader in adoption and innovation in the digital asset space. They got the first that application that they submitted for the Bitcoin ETP was what kind of broke the dam there. So I worked a little bit on that. I left about a year and a half ago to launch my own firm and to do some consulting for family offices and just general VC investment into the digital asset space, because a lot of these players were starting to get opportunities of investment into digital assets and being like, we need somebody we can trust to evaluate these for us. So I do a lot of that. I've also been hosting, as you said, Milk Road Macro for the Milk Road media company for the past year. And I've really, really enjoyed that. I love the community that we have there. Our pro community is fantastic. And we have a host of other pro analysts on the staff, in addition to myself, who are experts on everything from AI to digital assets and everything in between. We're just generally focused on understanding these mega trends in investing we see as artificial intelligence and digital assets and how these all come together. I host the Milk Road Macro podcast to give a macro backdrop to all of this, right? Because I think macro is driving a lot of things that are happening in all of these markets, and understanding that and giving some more robust context to that, I think helps our audience have that bigger picture framework. And so I've really enjoyed that. It's been a really great experience. I've gotten to interview some of the best investors alive and some really, really smart people who have been in markets for 30, 40 years, and then just get their take on what's going on, lessons from the past, their outlooks on the future. So yeah, it's been a really great way to not only be part of a larger community and kind of get closer to the conversation on what's going on, but it's been great for my own education, and I've just really enjoyed the experience there. And I like every time I have somebody on, I like bringing on bulls and bears, because I don't want to dictate to my audience one way of thinking or one way of seeing the economy or the markets, but to try to give them a pantheon of experts who have differing opinions and are reading things different ways and looking at different signals. And the other thing too I like about macro is that I can bring on niche experts. So I can bring on somebody who's an expert on the oil markets and talk about that, or somebody who's a precious metals expert, and an expert in the sense of down to who's settling what in physical versus spot, or all these different things. You can just learn so much from talking to somebody who's been in that industry as an expert for 30 or 40 years. And I frequently will bring on a housing market expert to talk about that market, because it's a huge multi-trillion-dollar market, but it moves very slow, and getting accurate data on it can be very difficult. So anyway, this is a little bit of an overview there, but yeah, I've been at Milk Road for a long time and doing Milk Road Macro, really enjoying it, learning a lot, and enjoying the community that we've built around that as we all go through this crazy market together.
Yeah, and crazy it is. And one of the things that helps you the most when it comes to markets is just time in it, right? Having the perspective, having seen things before. So when did you first get into Bitcoin?
I first got into Bitcoin back in 2016. I was aware of it before that. I remember the first time I heard about Bitcoin was when it crossed $100, and I remember like there's a buddy of mine I was in college with, who was like really excited about this. And he and a friend of his used to like send like 5 or 10 Bitcoin back and forth to each other, just to like show how it worked because nobody really understood, digital assets at the time. And yeah, so that was very early days, and I didn't buy in at the time because I was like, yeah, I don't really think this is going to work. I initially thought that there would be like a supranational, agreement made between nation states and governments to sort of outlaw this, or like put some sort of like gate on off ramp gate to make it so that if you put your capital into Bitcoin, you can never get it out again, sort of thing. But that did not happen. And in 2016, I worked on a project with some other partners around using a particular piece of hardware, a computing hardware called field programmable gate arrays, as mining hardware to mine Bitcoin. And the idea was that we'd be able to pivot from Bitcoin to another thing, whatever we wanted to hash or mine for at the time. The bubble burst and the funding pulled out on that. And I was like, okay, well, I want to go into the direction of digital assets and finance. So let me see what options are out there. And that's when I joined BlackRock. And so while I was at the firm, I stayed close to what everybody was doing on Bitcoin digital assets and was fortunate enough to help out on some of those things. But the real educational benefit to me was if you go to a crypto conference and BlackRock is on your name tag, everybody wants to talk to you. It's like being the prettiest girl at the party, right? So I could go up to anybody from any project, and I wouldn't like say I'm representing BlackRock or misrepresent that at all, but I would ask some questions about their project, and I could learn a lot just from having these candid conversations with the people who are at these conferences, who are experts on whatever project they're building, whatever they're doing in Bitcoin or crypto. And you can just learn a whole lot that way. So that was a huge educational experience for me. And then for, I think, a period of around 2 years, I was a writer for Discover Crypto, which is one of the largest crypto YouTube channels. And I really enjoyed that because that forced me, in order to write the videos that I was writing, I had to do deep dives and research on all these different digital asset projects myself and get a pretty intimate understanding of the space, the technology, the investment landscape, so forth, the use cases. There's always new ones that are coming out. So that was a great way, again, to learn. And I think that this whole process for me has been less about, going 50x long on meme coins and more about learning a lot about this technology and its adoption and how important it is to the continuing growth of, I think it's just really fundamentally important to the next century of finance, right? So that has been my focus, has been on education. That's what I have a passion for. And at the end of all my podcasts, I always say, stay safe, stay educated, stay bullish, because I think that there's a very long-term, robust thesis here. But you have to make sure you're protecting your assets because we are on the cutting edge, and that can turn into the bleeding edge of technology and in finance if you're not careful. But then stay educated. That's a real passion of mine, is helping other people understand these things, because I like to make this joke a lot, but I think Bitcoin combines everything that people don't like and don't understand about technology with everything that people don't like and don't understand about finance. And so it's something where it's really important for people to know about this, but it's not really fun to learn about it on your own. So I try to make these things understandable and engaging. And so I've always had a passion for that. But yeah, so it's now been around almost like on the nose 10 years that I've been in digital assets in some form or in Bitcoin in some form. And I've really enjoyed the ride. And I'm trying to continue moving my career in the direction of digital asset wealth management and content creation around digital assets and Bitcoin.
Wow. So if you've been around since 2016, I mean, this is your third cycle, right? And these cycles are defined by blow off tops. We saw one, of course, in 2017. We saw one in 2021, 22. And in 25, it was sort of a disappointing top, you could say, in Bitcoin. For a lot of Bitcoiners, we thought we were going to go much higher, 200K possibly. But instead, we peaked out at 126. And since we've been down about 50%, right? But we've seen the rest of the markets just continue their march upward. And that is one huge difference between now and the other cycles, because they've always lined up on these midterm election years, 14, 18, 22, and now 26, where Bitcoin crashed during these times, but the general market was down as well. So it didn't feel like we were being left out. It just felt sort of cyclical. This was part of the journey. Deal with it. Well, now we're seeing things like this, and this is the Kospi, right? This is the Korean stock index. It had gone essentially flat from 2022 up until last year, literally a year ago. And since then, it has tripled. It is up what 225% since June of 25. Of course, there are some big names driving this thing upwards, such as Samsung and HK or HY Hynix. I think
Hynix.
Hynix.
Yeah.
Yes.
Hynix,
So
yes.
I mean, of course, this is riding the back of the AI trade. We have Nvidia going like crazy upwards as well. What do you think is going on here? What is your take and your market experience? What does it tell you about this moment in history?
Well, it's bullish for one thing. Um, so I think that the Korean stock exchange traditionally has been driven a lot by bull runs in the technology sector because that's where so much of their economy is focused. And so you're seeing that reflected in their stock market there. That usually is a leading indicator that something the business cycle is accelerating. And an indicator of that traditionally has been there's been a strong correlation with movements of the ISM manufacturing PMI survey above 50, which I think a lot of people are probably familiar with this at this point. It's usually a very in the weeds thing. But basically, what that means is that purchasing managers are accelerating their purchases, and that means that the economy is reaccelerating, and that's usually a sign that the business cycle is picking up. And so all these things are kind of indicators that that's happening here. A big thing that's driving that is the AI capex spend. There's been I don't actually even know at this point. I think around 800 billion. There's probably more than that by now. But the Trump administration in the big beautiful bill put in a stipulation that said that AI capex in 2025 or 2026 rather was going to be 100% tax deductible, or like not tax deferred. Basically, they're not going to tax you on it. So it incentivized a lot of AI capex because the U.S. government views it as a issue of national security to be able to lead on artificial intelligence. And I think they're probably right about this. I think a lot of nations are viewing it that way, but China as well. But that's been a big driver of all these things. So you're seeing the downstream effects of that. So because of the government's posture around needing to basically subsidize and give tax deferred incentives for these companies to do this AI capex and to build out this technology and the infrastructure needed to support this technology, that's created a reacceleration in the business cycle, which has led to this increased demand and overvaluations in the Korean stock market and this whole big bullish bull run we're seeing here. So it's a lot of concentration around artificial intelligence and stocks related to that, beneficiaries of that. And if you're a price taker, in other words, like if you're trying to, there's a scarcity of energy and compute right now. And so if you're one of the companies that supplies energy and compute, you're doing incredibly well. And if you're one of the companies that's on the other side paying for energy and compute, you're looking at very steep prices and facing some headwinds as a result. So that's, I think, what's kind of driving all of these things. And there are other people who are like going to give you more detail or different answers on some of these things. But I think the big thing to understand is just that there's this huge, I mean, this is not groundbreaking news, but there's this huge arms race, economic arms race to get to generalized artificial intelligence or super intelligence, whatever word you want to use for it, first, and to dominate those markets. Both China and the US recognize this, and they're kind of pulling out all the stops economically and fiscally to be able to support that effort. And so you're seeing these like very extended valuations in a lot of the beneficiaries of that. And then I think the other thing to say here is that there's been an increased number of self-directed investors participating in the markets from prior markets. So because we've had the democratization of access to capital markets and particularly to equity markets, there have been a lot more self-directed investors, retail investors, whatever you want to call them, who are chasing these investing themes and trying to get returns on these things and using things like leverage or whatever new advantage. Like they're not just trading the spot markets, they're using perpetual futures contracts or whatever the case may be to get exposure to this. I think that's a huge amount of capital that's doing that. And it's, I think I call it like it's the rise of mimetic investing. We've seen this with GameStop. We've seen it with a lot of other things. We saw this big run up in silver when that debasement trade caught on. So this kind of like whatever the meme of the time is gets a lot of attention, gets a lot of capital. I think right now that's where the football is on a lot of these memory stocks, AI and tech stocks. And so until there's some, some paradigm shifting event that changes that, I think that momentum probably continues for now. But yeah, it's the valuations are wild, and you saw on that chart, like there's a lot of dips on that Korean stock market chart where they had to like stop trading because it sold off so fast, but then the dip gets bought up so quickly that it's like it's gone before you even realize it's there. So yeah, there's a lot of bullish momentum, a lot of buying pressure, and I don't think there's any like clear signs to me that it's going to slow down soon.
And one of the most important things you can do in a time like this is study history, right? Look back at prior times of financial bubbles. What led to them? How did they resolve? One common trait with all these, of course, is a technological revolution. We had the railroads in the mid 1800s, electrification in the early 1900s, the internet in the early 2000s, and now we have AI. So, and with all these technological booms, I mean, they built out, they created the world that we live in now, but it was very rarely that the first people that were through the door were the ones to reap the biggest profits, right? So you have this overspend in the beginning, and then it's a couple of years later that the people who are able to actually use this new technology and create benefit for the end consumer and get a lot of earnings. So talking about that, and you just said there's a lot of these retail is in the door. So I've got a chart to show that. What we have here is margin debt as a percentage of N2, all-time highs, right? People are taking big bets right now. And you talk to a lot of investors, and I'm sure you have a lot of people in your life that are playing these markets. Does it feel extremely frothy to you?
Good God, yes. Yeah, no, the simplest answer to that is just plain yes. I think that there's a lot of speculation. There's a lot of debt being created. I think the other thing I would say about this is that there's only a certain amount of people who are able to get the debts to participate in this. A lot of people are feeling very left out by this. They're feeling like they're not participating in this, that they're not part of this mega bull run, that they're not benefiting from the upside of this. And, people have called it the K-shaped economy. There's a podcaster I like named Adam Taggart who calls it the I-shaped economy, because there's like, it's not just like the half is on the top and half is on the bottom. There's a relatively small percentage of people who are really, really getting an outside benefit from this, and the rest of the population is struggling to find ways to participate. I think that's one of the reasons why you're seeing people taking such risk-seeking behavior, is that they feel this intense amount of FOMO, and they're worried about. There's this whole thing on Twitter about falling into the permanent underclass because you didn't participate in this bull run, and it might be the last bull run in history. And oh my God, what am I going to do if I don't have a share of SpaceX or whatever the case may be? So, yeah, I think there's a lot of FOMO and pressure to perform and to participate in this, because people are worried that if they don't, that it could cost them and their families their futures in many ways. So I don't know. There's a lot of market psychology around this that goes into why people are doing all that. But yeah, that frothiness is there, and it's eventually it will turn around, slow down, something will change. But for the short term, it seems like most nations are trying to incentivize this. Like the federal government has said they want to quote unquote run it hot, economically speaking, because they're trying to encourage this economic growth and build out to remain leaders on artificial intelligence. At the same time, a consequence of trying to run the economy hot is that the markets tend to go into bubbles and to overvaluations and to see all of this froth. So in some sense, it's almost being encouraged by government policy. And yeah, I don't know. It's a time that creates a lot of concern for me, because I think there are a lot of people who feel like they don't have any capital or equity or agency in this situation, but they're compelled to take outsized amounts of risk, or even in some cases be a little bit reckless, because they feel like if they don't, they're never going to have a chance to have a better life. And I think the point you made too about like, when a lot of commodities experts I interview say this, that when you have shortages in commodities, on the other side of that is a glut, meaning if there is a short supply of something that is a commodity, producers will step in to meet that demand, but they will usually overproduce. And then on the other side of that, you have an overabundance of whatever that commodity is. So this is what happened with the railroads, right? We overbuilt the infrastructure for railroads, and it took, I think, around 10 years to be able to utilize all the track that was laid. I think, you're seeing a lot of things like Elon Musk and others have said that compute and energy are going to become a commodity, and that kind of rings that bell to me, right? Like we might overbuild so much compute capacity with these data centers that it might take us a long time to catch up to that, and there'll be, a glut of a compute. There'll just be an overabundance of computing power. I think that's the direction we're trying to go right now, because we have such insatiable demands for computing power that there's not really an end in sight to that. So they're building like there's no tomorrow, because so far that seems to be the case. But that is something I think about, which is that on the other side of this, there might be an overabundance of supply of certain things that are built out for this. And the other thing is that a lot of these hyperscalers, these mega cap, multi-trillion-dollar companies, view this as existential for all of them. They've all devoted their free cash flow to this. They've all, well, not all of them, but most of them have gone into certain kinds of debt. They're now tapping the public markets with IPOs to be able to source even more capital for these things. And they're doing it because they view it as an existential thing, and sort of like a winner take most, if not a winner take all environment. So they're all trying to basically compete each other out of business. Well, if somebody does ultimately win that, you're talking about multiple trillions of dollars of not necessarily malinvestment, but like somebody's got to go to zero, right? So yeah, there's just a lot of risks that are posed from this, and the frothiness makes me concerned. So I think it's a great time to use caution and try not to lose your head while all of this is happening around you.
Yeah, FOMO goes hand in hand with the saying, this time is different, right? And that's the explanation that always drives people to buy into things when they have gone vertical. And I think a great graphical representation of what you've just been talking about is this. So this is SOX, the Philadelphia Semiconductor Index. And these semiconductors are the commodity that is at for the fundamental level of this whole entire AI revolution, right? So this was back in 2000. It ran up and went vertical. Then there was an overproduction, right? And so prices crashed down and went sideways for a very long time. It's crazy how identical these two charts are of the same exact index. Wild times here. And another thing that's sort of
that's scary, but yeah, continue.
But what we're seeing now also in this modern world of 2026 is that it's sort of like this hot ball of money, right? That can just move so quickly between different indexes, different stock markets around the world, and different assets. So you just had Heinrich Sieberg on the show, and that was a great interview. I highly recommend everybody to go check out Milk Road Macro after this and check out that interview, because it really had some contrarian takes that were certainly very, very interesting. But what he was saying was that right now, of course, as the chart we just brought up before was the Kospi, and the Kospi has gone straight up. And so that money he thinks is going to rotate outside of Asia, which is sort of the periphery, and go to the quote unquote safe stock markets, which are in the US, right? And we're already seeing the US stock markets go crazy. I mean, the Dow Jones Industrial is at an all-time high, over 52,000. Again, the SPY is near an all-time high. And the Qs are also very close as well. So could this go another straight up rally? Who knows? But it does seem as if the money is hotter than ever and can move faster than ever. So what do you take on this thesis that that money can rotate like never before now?
So I think an interesting way to look at all of this, I just want to back up a little bit and reframe this. I think that it's important to understand the difference between nominal and real returns, because all of this is denominated in dollars or some sort of fiat currency. And that is what is getting obliterated. It's not necessarily true that all of these things are exploding in value. And a lot of these top line indices look like they are going on the top line. In other words, the overall index is going to these huge levels of overvaluation, but the concentration of capital is in a few names, and it's not like the entire S&P 500. The 490 stocks that are not part of this AI hyperscaler trade are not necessarily doing well. There are this is an important thing to say too. There are a lot of very strong, sound businesses that are trading at really modest PE ratios with very sizable amounts of free cash flow that cannot find investors who are interested in owning them, because everyone is losing their minds about owning the next data center on Mars, or like et cetera, whatever the case may be, right? Like this whole AI craze has got all the attention and all of the capital. This is what I said before about mimetic investing, right? It creates FOMO, and this all tends to clump up in certain assets. So that's an important thing to understand, is that a lot of this is momentum. A lot of this is the top lines are moving higher, but the concentration is very small. If you look below the label, you can see a lot more information about these things, right? So that's important to understand. The thing about nominal and real returns is that over time, over history, if you adjust for inflation and just for the growth of the monetary supply M2, a lot of these indices are relatively flat or down. And I think that's important to understand as well. So what's really happening here is that governments are borrowing, they are going into debt, they are creating deficit spending and expanding their debts, and doing that because they need to continue to stimulate economic growth and kind of make up for the fact that the population is not growing, to expand that economic growth. So they're using paper to kind of cover that and keep it growing the way they need it to, even though it's on real terms, it's not. So there's a gulf between nominal and real terms. That's what's creating all of this liquidity. Liquidity basically just means like the ability to get access to debt, because we are not in a monetary system, we are in a debt system. We are using debt as money. This is important to understand. I think this is like a very in the weeds, wonky economist, monetary theorist thing, but I think it's important to understand the difference here. If you are using a monetary asset of debt as money, one way to describe money, there are a lot of definitions for money. One way to describe money is that which cancels debt. So if I owe Rob $100, I'm not giving him $100 of value. If I give him $100, I'm substituting debt that's owed by the US government to the Federal Reserve. That's what a dollar is. It's debt owed by the US government to the Federal Reserve. So I'm substituting that debt owed by the US government to the Fed for my debt of me to Rob. So that's what happens when I give him $100. So that's an important thing to understand. It used to be many years ago, before 1972, and Richard Nixon took us off of the gold standard, that dollars would be able to be exchanged for gold. And that was the monetary asset backstopping the system. Once we switch to the fiat system, fiat just means faith. So it's all just faith that the federal government will pay back the central bank, the Federal Reserve, at some point. So you have to understand these things. This is important baseline stuff. It's like a fish doesn't know it's swimming in water, but you're swimming in water, and this is the water that you're swimming in. You're swimming in a system of fiat currency, not monetary assets, and you are swimming in a system of nominal returns, not real returns. So that's why all these things are happening, and it's important to understand that. Now, as far as this capital rotation that Heinrich talked about, first of all, I love Heinrich. He's a very colorful person, very convicted in his beliefs, and a very, let's say, rigorous economic student. And people can say whatever they want about his takes, but what he's saying is that all of this liquidity is desperately seeking returns. They're seeking nominal returns. And these markets are enormous. The amount of capital that's been pumped into them is enormous. The US government alone is at $39 trillion of debt, and that just keeps climbing at basically a breathless pace. The US government tried to do this Department of Government Efficiency initiative, and that just didn't work. And so they're still spending at record rates. The Trump administration had tried to be like, oh, we're going to be austerity, we're going to do Doge. But then they just said, hey, this isn't going to work. We're going to have to run it hot. And now they're spending at even more accelerated rates than prior administrations. So it's important to understand where all this is coming from. It's just the paper exploding. It's not anything else necessarily getting more valuable necessarily. So that these are important things to understand. The thesis here is that the capital rotates. So as people get these nominal returns in one asset, one index, whatever it may be, they will take profits and then rotate that into other places that haven't had these asymptotic blow-offs yet. And then you'll see that price performance start to happen. And this becomes reflexive, right? So reflexive meaning price appreciation begets price appreciation, and speculation begets speculation. This goes back to the mimetic investing thing I was talking about. Once something starts to move, people start to develop a thesis, it starts to catch on, it gets a lot of momentum. And we've seen this happen in like stocks, single stocks like GameStop. We've seen it happen like in silver earlier this year. We're seeing it happen in all these memory stocks right now. And I think that there's reason to think that it'll continue for a while. But what Heinrich is basically saying is that before this kind of breaks down, before the leverage gets washed out, before we have a bear market happen of some kind, like, going down the other side of that chart, he's expecting that capital to continue to rotate because he doesn't think that this is over yet. And I tend to agree with him. Now, I don't know if that rotation will happen. I don't know where that rotation will go to exactly. But I think that that's something to be mindful of, is that just because the big spotlight, the hot ball of money is on one particular asset right now, doesn't mean it'll stay there. And I think it's in some sense this tension between the fear of missing out on the hot ball of money and all the profits that are getting made on paper, the nominal gains, versus trying to evaluate assets or like equities and assets, whatever the case may be, for their real value, and trying to be a value investor while the market is like, ignoring you because they don't agree with your thesis and they don't care about the fundamentals. They just want the hot ball of money. So that's kind of the situation we're in there. I forget what the original question was, but there's just a lot of thoughts to be mindful of. People need to like have that perspective, because I think so many times it's easy to get caught up in just the FOMO of the moment. But you got to remember like a lot of these different distortions in the market that are happening because of the system that we're in.
And thank you so much for that. That was brilliant. And I love the fact that you bring up that it's not a monetary system, it's a debt system, right? That's what we are functioning in, and we don't even realize it on a daily basis. And it gets back to the fundamentals of why so many people are here in the first place, why they care about Bitcoin, because they know that the money that they use on a daily basis is being inflated away, that the price of a hamburger was half the price it was 10 years ago than it is now. So why do people need a deflationary money like Bitcoin? Because it's an honest measure of account. It keeps people centered in a reality where one Bitcoin equals one Bitcoin. And just because Nvidia went from $20 to $200, it doesn't mean that it can buy you more in the long scheme of things, right? So yeah, everything in life is getting more expensive because the dollar that you're using is getting more and more worthless. But my question for you is, on the other side of these blow off tops, when the market comes crashing down and prices go down, where does that value go? Does it just disappear? Does the debt get squashed? Or is it just a movement again into something else?
I don't think it disappears. I think it just keeps moving. And I think it just like hard assets are going to continue to do well because, the nominal denomination, the denominator is going to keep getting obliterated. To me, that's the long-term trade here. This is why I'm still extremely bullish on Bitcoin. I don't know whether or not Bitcoin is ever going to become the global, monetary standard, but I do know that the dollar is going to keep losing its value, right? Like it's like I know that ice cubes melt in the sun. I know that the dollar is going to lose its value. I know that Bitcoin is not going to lose. They're not going to make more Bitcoin. It's 21 million hard coded at the protocol level. There's some, speculations about that could be changed, but not for many, many years, and not for any reasonable reason that I can see at the moment. So that to me is the thesis, right? That thesis is very strong, and that holds for many years, and that is why I think that Bitcoin is a differentiated asset here. And we have seen periods of euphoria and speculation on Bitcoin, and that hot ball of money has rotated into Bitcoin and into crypto many times in the past. I'm sure it will again. But I also think that you can see like the 2020 floor was around $3,000. Then I think the bear market was around $17,000. Now we may be finding a floor here around $60,000. We could go lower. I'm not going to get into that debate at the moment, but my point is that there is a growing amount of capital and of market participants who are recognizing the need for an asset like this and the value of it, and they're allocating accordingly, and that's starting to grow. And I think this is going on an exponential curve. It's just hard to see because logarithmic growth, exponential growth, is hard for people to understand. So it's not just so to get back to your question, right? Where does that value go? I don't think it gets destroyed. I don't think it gets crushed, but I think that the fiat value does continue to get obliterated, and people are going to continue to try to find a life raft, a way to protect their capital. And that's really what people are trying to do. They're trying to preserve and protect their capital from this financial repression, of the consequences of all this deficit spending, right? So you do that with hard assets, and you do that with assets that are outperforming the inflation and the debasement of the currency. And so that's why they're trying to find alpha in memory stocks, in silver, and whatever the case may be. There are a lot of assets that can fit that thesis for different investors at different times, for different portfolios, etc. But I think that Bitcoin has what I would say a unique role to play in a portfolio. It's a unique diversifier. I didn't write this paper myself, but one of the white papers, think pieces that was published by BlackRock while I was there was titled "Bitcoin: A Unique Diversifier." And so I think one of the things that's interesting about Bitcoin is that it has been moving in an uncorrelated manner to a lot of these other markets, and I think that makes it a unique diversifier for a portfolio. Right? It's not just moving in sync with everything else. And so that makes it attractive for that reason alone. But we'll see where this rotates to next. I'm not really in the business of trying to predict where the hot ball of money goes.
Mhm.
I'm mostly just trying to pay attention to where it is, and then have a thesis for protecting my capital independent of it. Right? I'm not trying to spend my life chasing the next meme stonk. I want to be protecting my capital for a longer period of duration, and that higher time preference is one of the reasons why I like Bitcoin so much.
And you've been in Bitcoin since 2016. So you've seen this run up from $100 up to 20,000, then crashing down to 3, right? Then running from
Mhm.
3,000 up to 60,000 and crashing down to 15. And now from 15 up to 126. And now we're back at 65. So this thing is a brand new asset. It is getting monetized in real time. And it's better to judge it by its lows than its highs, right? To go from
Yeah.
3,000 to 15 to 65 right now. Is this the low? We don't know for sure yet, but it could. There's a large base right here building, so this could be it, and we could be going up not too long from now. But if you look at other assets, other hard assets, I mean, silver, right? Like silver ran up to $50 in 2011. I remember this actually. This was around the time that I got hard money pilled, Austrian pilled, Ron Paul pilled. And I thought that, yeah, we're about to experience hyperinflation, that this was going to run away, that since the financial crisis of 2008, 2009, they pumped over $1 trillion into the economy and that the dollar was going to immediately hyperinflate. And if you looked at this run up, it went straight up and you thought, yeah, we're on that trajectory. You got to put everything into silver. Well, no, it crashed. It went from $50 down to $14 and it stayed there for a long time. And it went up a little bit during COVID, but crashed back down again until we saw this parabolic run up just in the last year or so. And the same with gold. Gold ran up to 2,000 bucks back in 2011 and then just languished here for a decade, getting up to 2000 again after COVID, but then finally having this run up here. So these things can happen fast, right? And the markets really like to bore you out, to wear you out. Talk about that, the difference between having the patience to really see these grand macro theses play in
Yeah.
your
So
favor.
I think you're talking about time-based versus price-based capitulation here.
Yes.
Sometimes people will capitulate because the price just gets crushed and they think it's never coming back and they'll give up. Sometimes people capitulate because they're tired of waiting and they've been holding something with a thesis for a really long time. Michael Burry in the movie The Big Short says, "I might be early, but I'm not wrong." The problem is that in investing, being early is the same thing as being wrong many times. So everybody has to kind of evaluate that for themselves and figure out what their opportunity cost is, how long they're willing to hold, how long their time horizon on their thesis is. Charlie Munger said, in order to be a good investor, you have to be able to endure your portfolio dropping 50% with equanimity, which means very calm peacefulness, and just watch it drop 50% and be like, that's okay. The thesis is longer. The thesis is still holding. I'm gonna wait this out. So you kind of have to know for yourself what your thesis is. If the thesis is played out, if it's changed, if the time horizon was a shorter one for you and it moved against you, you got to know that and cut your losses. But if you do have a long perspective on this, I think it pays to wait on these things. Gold and silver I think are really interesting because a lot of people do not associate these 10,000-year-old monetary assets with being meme stocks, right? Or meme assets, right? But that's exactly kind of what happened, and we saw the effects of that. I think that there are a lot of theses behind both gold and silver, right? The silver has a lot of industrial demand for weapons manufacturing, for all kinds of different technology, and so there's a lot of demand for these things. I think another thing to remember is that in China, people have a similar problem that we have in the United States. If they're an investor, if they're trying to protect their capital, they need some kind of debasement hedge. They need somewhere to go, and they don't. Let's just say that their stock market is not as trustworthy or as deep or as liquid as ours. So you've seen a lot of them trying to protect their capital in real estate. A lot of them are trying to protect their capital in gold and silver. And I think that's one of the things that drove that big run up was just there's so much nominal currency. There's so much liquidity that needs to go somewhere. It's desperately seeking a home to protect itself from this debasement. And you start to see things like this works or this is performing or this thesis makes sense to me. And you can see these huge rushes of capital into these things. So I think it's a question of understanding your time horizon, understanding your investment thesis, understanding what makes sense for your portfolio, how you want to protect yourself, and then I think just not trading on emotion, right? Because it's so easy to get emotional in one way or the other, either time-based or price-based capitulation. But making sure that you're not allowing your emotions, how you feel at the moment, to dictate your investment choices, I think sets you up well for performance over the long term. And it's there's no way to predict when those kind of blow off tops will come, right? I mean, it's cyclical in some sense, but it also isn't, right? Like silver, I think it was like the 80s was the last time, and then there was like a 40-year base, and then it finally broke out of it. But Yeah, so it's about understanding what works for you, what your thesis is, and then having a plan and sticking to it, and not getting shaken out by emotion. Because there's so many people right now, I think, trading on emotion, and I think that's a dangerous mistake, a dangerous thing as an investor, because it can lead you to making mistakes.
And investing really is a game of wits, right? And the most gratifying thing is being right when you're playing a game of wits. And so when you invest in Bitcoin and it's going up, you feel right. You feel like you're intellectually superior, maybe, to your peers who don't see the brilliance of this finite, limited, scarce supply asset, the first digital scarcity ever. But then when it goes down, you feel dumb. But at the end of the day, if you do the education, if you have the conviction, you can wait out these drawdowns and accumulate more when it's cheap, right? If you really believe in Bitcoin, you're getting it half off right now, and that should make you excited. And next, I want to dive into what is going on right now in terms of Bitcoin and sentiment and get your view on it, because you are a 10-year veteran in this space, and compare it to other drawdowns in the past. But before we do that, we have to give a big shout out to our friends over at Rhino. Previously, getting access to Bitcoin financial services was slow, clunky, and scattered across all these different platforms. But Rhino is changing that. Rhino is a next generation Bitcoin banking app designed to handle all of your Bitcoin needs in one place. Buy Bitcoin with some of the lowest fees anywhere. That means more sats for every dollar that you spend. Make Lightning payments over the Lightning Network instantly with near zero fees. Send cash globally fast and easy on Bitcoin rails. And of course, you can DCA, set up automatic savings plans so you stack sats on your schedule and build wealth over time. And with Rhino, you can also take out a Bitcoin-backed loan through Arch on the app itself. Soon, you'll be able to pay bills, direct deposit, and even save for retirement. And of course, Rhino takes security of your Bitcoin with the utmost attention. They use biometric verification, 24/7 fraud protection, and confidence of knowing your Bitcoin is never, ever rehypothecated. Use the code Bitcoin News, one word, Bitcoin News, and Rhino will drop you $10 of free Bitcoin in your account just for getting started. Rhino keeps you in control of your Bitcoin all of the time. Thank you so much for the team over there. They're doing a lot of great things, and they've also got a big giveaway going on. Sign up. They got this thing called Sats Drop. You win free Bitcoin. It's like a Plinko game, and they've got a giveaway with some great prizes in the Bitcoin community starting this Saturday. So go check that out. But John, you've seen drawdowns in Bitcoin before, but right now the mood is pretty sour. How would you evaluate sentiment within the Bitcoin space at this moment?
Yeah, so I think this is a really important topic to talk about, and to talk about sensitively, because I think a lot of people are feeling exactly what you said. They're feeling a little bit silly. They're feeling like they've been taken for a ride. They feel embarrassed. They feel like they're getting outperformed by their grandmothers. Um, so I think there's a lot of real emotion that goes along with that. And I don't want to be too flippant about that. I think I've been in this market long enough to not really feel so much of that myself anymore, but I think it's still a very real concern, especially for people who are new to this asset class. So I just want to take a moment to just be human and validate that that's a real thing. It's really frustrating. It can be really scary, especially if, finances are tight, which they are for many people. So I just want to start with that. I think I'm feeling this in a very public way right now. Our Milk Road team, as I said, our pro analysts, all of them, we have portfolios that are public and that we manage and then people trade on. And I'm been getting outperformed. I'm getting shellacked basically by the people who are aggressively trading these AI stocks, and they're doing well. And I think that their thesis makes sense, and I'm really glad that they're doing that. And I think it's a huge value add for our community to have their contributions. However, my portfolio right now is very concentrated in Bitcoin and crypto, and I'm not like in the alt space right now, but I'm watching those for accumulations, because I think if Bitcoin does find a bottom here, there is some value in the digital asset ecosystem outside of Bitcoin that I'm interested in having exposure to. But in any event, I'm kind of very publicly getting not made fun of, but like, let's say it's clear I'm not winning, right? And it takes a bit of confidence to say, okay, this is still my thesis. This is how I want to invest my capital. And another thing I think is a mistake that people make is that they try to become an expert on everything, so they end up being an expert on nothing. And I think as an investor, it pays to have a degree of concentration, not just with your capital, but with your time and attention. You can become an expert on AI stocks or on digital assets, but becoming an expert on both is a bit difficult, I think. So you have to know how to play to your strengths as an investor, and to, I think, pick how to concentrate your capital to give yourself the best setup you can for a return on investment. The other thing I'll say about this is that sentiment golf, I think, is very much limited to self-directed and retail investors. The institutional bull run has never been stronger. I said this on my live stream today, but I went to a networking event at BlackRock yesterday, and just like caught up with some colleagues. It was like an alumni networking thing that they had. So I went back. It's the first time I've been back in over a year at this point. But I talked to a lot of people. There is a huge amount of demand, interest, investment of talent, of capital into this tokenization move and the adoption of digital assets in many, many ways. BlackRock, I think, just recently or in the near future, is going to launch a new Bitcoin ETF product, or ETP product. It's technically an exchange traded product, so it's an ETP. But in any event, they're bringing out new products to market. They're launching new services and products. All of these institutions, not just the asset managers like BlackRock, but banks, all different kinds of financial services companies are forced to come up with some sort of strategy for digital assets, for an allocation for product and services. They're competing fiercely with one another. They're innovating all the time, and they're trying to gain market share here. So the bull run, the bullish sentiment, has never been stronger on the institutional side of the market. On the retail side of the market, it has never been worse. And I think that's because the October 10th flash crash was just really demoralizing for a lot of people. And that speculation enthusiasm has not really come back. A lot of people have felt scammed. They felt betrayed. They felt like Sam Bankman-Fried rug pulled all of them. The meme coin super cycle, I think, took a lot of energy and capital from people, and they don't really get a return on a lot of that. And so they're feeling a little bit, I think, disillusioned at the moment. This is the gulf that I see as what I've just called this bullish divergence. The fundamentals have never been stronger. The adoption has never been stronger. The commitment of institutional capital has never been stronger. So the investment thesis for me in digital assets like Bitcoin has never been clearer and stronger and more robust. The sentiment has never been lower. That, to me, is the time to be accumulating, which is what I've been doing. I bought at 60K. I've got some more bids around there. If we go back to that level, if it goes lower, I'll just buy more. I really don't care if it goes to 40K or not. I'm really in the weeds on whether or not I think that'll happen. I think 60 is a reasonable double bottom floor for us. If we dip below, I'll just keep buying it. But setting all that aside, the point isn't whether or not I get a couple of $1,000 better deal on Bitcoin. The point is the apex asset, the best performing asset in history, is at a point where it's got a cleaner thesis and a stronger thesis than it has ever had before, and nobody wants to buy it because they're all chasing data centers on Mars. I'm not against Elon Musk by any means. I'm not shorting space. I'm not opposed to that at all. However, the best asset in history is at bargain basement prices, and nobody's buying it. And that, to me, is the opportunity that I see in the markets. So I try to reframe this, right? Like, I don't reframe this as I'm underperforming everybody else. I reframe this as I'm being presented a multi-year best buying opportunity on one of the best assets in the market that does protect my capital and that does have a strong thesis that I feel comfortable with for 5, 10 plus years. That, to me, is a great opportunity as an investor. So I'm excited about that. I'm not like, mortgaging a kidney to go all in or something like that by any means, because I still don't want to be reckless with risk on any of these things. But I just think it's a great opportunity. So if somebody is feeling that way, I want to validate that it is tough to have this level of FOMO and to feel like you're missing out on all of this hot ball of money. But at the same time, if you step back and look for the opportunity that everyone is missing, then I think that there's a huge opportunity. There's just tons of value right now in the digital asset landscape that people are underappreciating, misappraising, misvaluing, misunderstanding, and it's an ignorance thing. And I think, frankly, a frustration thing. It's an emotional thing, not necessarily tied to the long-term value of the space. So that's how I think about this. I could be wrong, but that's how I see it, and that's how I think about it, and that's how I'm managing this myself.